Indian Economy by Ramesh Singh. Chapter 13. Insurance in India. Insurance is a kind of gambling in reverse, a major form of risk spreading. One person's risk, which would be large, is spread around to make it small for a large number of people. In this process, it serves two purposes: provides social security net to people and helps in nation building by making available investable capital. Definition. In economic terms, anything used to cut down the risk is known as insurance. But in familiar terms, insurance is provided by an insurance company which covers a person's life, called life segment, or covers loss of assets, property, called non-life or general segment. The insurance policies are purchased at fixed premiums. Insurance industry. Insurance has a deep-rooted history in India. It finds mention in the writings of Manu, Manusmriti, Yagnavalkya, Dharmasastra, and Kautilya, Arthasastra. The writings talk in terms of pooling of resources that could be redistributed in times of calamities such as fire, floods, epidemics, and famine. This was probably a precursor to modern-day insurance. Ancient Indian history has preserved the earliest traces of insurance in the form of marine trade loans and carriers' contracts. Insurance in India has evolved over time, heavily drawing from other countries, England in particular. LIC. The life insurance business or industry in the country was nationalized by the Government of India in 1956 and a fully government-owned company, the Life Insurance Corporation of India, LIC, was set up. At that time, 245 Indian and foreign companies were playing in the life segment of insurance. Opening of private life insurance companies was prohibited at that time. The LIC was called an investment institution by the government. The nationalization was motivated by twin objectives. First, to spread the message of life insurance for greater social security, and secondly, to mobilize people's savings, collected as premiums, for nation building. The LIC had been the biggest investor in the government's process of planned development, purchasing government securities, G6, and equities of the big asset public sector undertakings, PSUs. GIC. In 1971, the government nationalized the private sector companies, 107 Indian and foreign companies, playing in the general insurance segment, and a government company, the General Insurance Corporation of India, GIC, was formed in 1972. The GIC started operation on 1 January 1973 with its four holding companies: 1. National Insurance Company Limited, 2. New India Assurance Company Limited, 3. Oriental Fire and Insurance Company Limited, 4. United India Insurance Company Ltd. In the era of economic reforms, two major changes took place in this area. 1. In November 2000, the GIC was notified as the Indian reinsurer, to be known as GIC Re. 2. In March 2002, the GIC was withdrawn from holding company status of the four public sector general insurance companies. Now these four companies are directly owned by the Government of India. ACIL. The Public Sector Insurance Company, Agriculture Insurance Company of India Limited, ACIL, was set up by the Government of India in December 2002, commenced its business in April 2003. This is a dedicated agri-insurance company and aims to serve the needs of farmers better and to move towards a sustainable actuarial regime. This company was responsible to look after the National Agriculture Insurance Scheme, NAIS, which was launched in 1999. Since January 2016, the company is looking after the newly launched PMFBY, Prime Minister Fasal Bima Yojana, which subsumed the existing agri-insurance schemes, the NACE and the modified NACE, of 2010. Till the ASIL was not set up, the agri-insurance responsibility of the government was being looked after by the General Insurance Corporation, GIC. ASIL is jointly promoted by public sector insurance companies and development financial institutions, majority shares owned by the GIC, 35%, and NABARD, 30%, while the four public sector general insurance companies own 8.75% each in it. Public sector insurance companies. At present, there are 6 public sector insurance companies in India. Out of it, 1 deals in the life segment, LIC, 4 are involved in the non-life, general insurance segment, and 1 is the dedicated agri-insurer. Other than these companies, there is 1 reinsurance company, the GIC Re, wholly owned by the GOI. Insurance reforms. Under the process of economic reforms, an Insurance Reforms Committee, IRC, was set up in April 1993 under the chairmanship of the ex-RBI Governor R.N. Malhotra. The committee handed over its report, January 1994, with the following major suggestions. 1. Decontrolling insurance sector, i.e., allowing Indian as well as foreign private sector insurance companies to enter the sector. The government did it in 1999, passing the IRDA Act. 2. Restructuring the LIC and the GIC and cutting down the government's holding in them to 50%, no follow-up still, but the private insurance companies demanding it anxiously. The NDA government had taken steps in this area, but the UPA government has no such plans. Late 2012, the government started sale of the LIC shares, but to public sector undertakings, seen as a welcome move. 3. Delinking GIC and its 4 subsidiaries, which was done in 2000. 4. Discarding the system of licensing of surveyors by the Controller of Insurance. 5. Restructuring the Tariff Advisory Committee. 6. Setting up a regulatory authority for the insurance industry, the IRDA set up in 2000. IRDA. The Insurance Regulatory and Development Authority, IRDA, was set up in 2000. The Act was passed in 1999, with 1 chairman and 5 members, 2 as full-time and 3 as part-time members, appointed and nominated by the government. The authority is responsible for the regulation, development, and supervision of the Indian insurance industry. Today, 57 insurance companies are operating in India, of which 24 are in life segment, while 33 in non-life segment, 1 public sector life insurer, LIC, 4 public sector general insurer, 2 specialized insurers, ASIL and ECGC, 1 public sector reinsurer, GIC Re, and 4 foreign reinsurers. India allows 49% FDI in insurance sector under automatic route. By early 2020, the government was considering to enhance it to 100%. By late 2019, the government allowed 100% FDI in insurance intermediaries. Reinsurance. Insurance is a very risky business. While the insurance companies offer insurance to its clients, they themselves get exposed to very high financial risks. Reinsurance business emerged out of this reality. When an insurance company buys insurance cover for its insurance business, a new segment comes into being, i.e., reinsurance. Experts believe that in absence of reinsurance, insurance industry in a country will not grow to the level of the social requirement, as insurance companies will either not provide insurance cover in several areas or they will charge very high premiums on the policies they offer. to neutralize the risk. Keeping this thing in mind, the Government of India took initiative to convert the existing public sector general insurer, the GIC, into a reinsurance company in 2000. Known as the GIC Re, it remained the only reinsurance company in the country till now. Over the time, this emerged as a major player in the global reinsurance industry. Reinsurance industry is regulated by the IRDA in the country. Reinsurance industry has a very low penetration in India. Lack of competition has been cited as a major factor behind it. It has only one player by now. To promote competition and vibrancy, the IRDA announced, late 2015, to open up the industry for the entry of foreign companies. In March 2016, the IRDA gave initial approval, known as R1 in regulatory parlance, to 4 foreign reinsurance companies. Among them, to belong to Germany, Munich Re, Hanover, 1 each to Switzerland, Swiss Re, and France, SCOR. Munich Re is the largest reinsurance player in the world, while Swiss Re is the second largest, and Hanover comes third in global size. Two other foreign companies, US-based Reinsurance Group of America and UK-based XL Catlin, are waiting for the initial approval. These companies will start their operation once they get the final approval, known as R2. Deposit Insurance and Credit Guarantee Corporation, DICOC. DICOC was set up by merging the Deposit Insurance Corporation, 1962, and the Credit Guarantee Corporation, 1971, in 1978. While deposit insurance had been introduced in India out of concerns to protect depositors, ensure financial stability, instill confidence in the banking system, and help mobilize deposits, the establishment of the Credit Guarantee Corporation was essentially in the realm of affirmative action to ensure that the credit needs of the hitherto neglected sectors and weaker sections were met. The essential concern was to persuade banks to make available credit to not so creditworthy clients. After the merger, the focus of the DICOC had shifted onto credit guarantees. This owed in part to the fact that most large banks were nationalized. With the financial sector reforms undertaken in the 1990s, credit guarantees have been gradually phased out, and the focus of the corporation is veering back to its core function of deposit insurance with the objective of averting panics, reducing systemic risk, and ensuring financial stability. Insurance cover available on bank deposits was increased from the existing 1 lakh rupees to 5 lakhs rupees by the government on 1st February 2020. The move announced in the Union Budget 2020 to 2021 was believed to come in the wake of the recent crisis related to the Mumbai-based Urban Cooperative Bank, the PMC, Punjab and Maharashtra Cooperative. For deposit insurance, depositors do not pay any premium, rather a nominal premium is collected by the DICOC from the banks. The scheme covers all banks operating in India including private sector, cooperative, and even branches of foreign banks in India, with certain exemptions like deposits of foreign governments, deposits of central or state governments, and interbank deposits. Background: in 2017 to 2018, the government proposed the Financial Resolution and Deposit Insurance (FRDI) bill, which aimed to reform the existing provisions related to deposit insurance and credit guarantee. The bill was criticized for the clause which allowed writing down of the liabilities of the failed bank. This clause was inferred by stakeholders as the bail-in clause when a financial help comes in from within the bank or financial institution. The Joint Parliamentary Committee also had certain apprehensions related to it. Government withdrew the bill in July 2018 and announced the need of more time to examine the related issues. Since 1991, the deposit insurance limit has been up to only 1 lakh rupees. Many countries revised their deposit insurance limits after the global financial crisis of 2008. The limit was increased up to US 1.15 lakh in UK, set around 3 to 4 times of the per capita income of these economies. Emerging economies like Brazil and China have set this limit at 9 times of their per capita income. In case of India, it was still a little over its per capita income, which was estimated to be 1,11,782 rupees at constant market price, as per the Economic Survey 2017 to 2018. Export Credit Guarantee Corporation, ECGC. The overseas projects undertaken by the Indian companies face many political and commercial risks in the importing countries. To provide adequate credit insurance cover to such firms, the government has set up the Export Credit Guarantee Corporation of India Limited, ECGC, under the Ministry of Commerce and Industry, for medium and long-term exports. But owing to its own limitations, at times it is difficult for ECGC to cover pure commercial risks in issues like long repayment period, the large value of contracts, difficult economic and political conditions of the importing country, together with the fact that reinsurance cover is generally not available for such projects. Many times, such projects look necessary considering the economic and political relationship of India with the proposed importing country. It means that in the absence of credit insurance cover, the ability of Indian exporters to go for such export projects is hampered. It should be noted that in many developed economies, such projects are covered and underwritten on government account. National Export Insurance Account, NEIA. For facilitating the service of the ECGC, discussed above, the Government of India did set up the National Export Insurance Account, NEIA, in March 2006 to promote medium and long-term export by providing credit insurance support in the cases where ECGC was not able to provide credit cover on its own because of purely commercial reasons. 1. The corpus given to the account was 66 crore rupees, raised to 246 crore rupees by 2007-08, and was enhanced to 2,000 crore rupees in the 11th Plan, 2007-12. 2. Resources of the NEIA will be the corpus, the premium income, interest income, and recovery of all the claims paid. 3. As per the provision, an exposure equal to 10 times corpus can be taken by the NEIA. The NEIA can cover projects which fulfill the following criteria. 1. The project by itself should be commercially viable. 2. The project should be strategically important for India with regard to economic and political relationship of India with the importing country. And 3. The exporter should be capable of executing the contract, as evident from his previous track record. The use and benefits of the NEIA need to be publicized among its beneficiaries. Meanwhile, many export projects pertaining to Indonesia, Vietnam, Iran, Sudan, etc. are underway. The NEIA will facilitate potential project exporters to enter the international trade area, as it is expected to be so. In the era of globalization, it has been praised as a welcome development by the experts and the trade people alike. The challenge ahead. Since the opening up of the insurance sector, the number of participants in the insurance industry has gone up from 7 insurers, including the Life Insurance Corporation of India, LIC, 4 public sector general insurers, 1 specialized insurer, and the General Insurance Corporation as the national reinsurer, in 2000 to 52 insurers as on 30th September 2012 operating in the life, non-life, and reinsurance segments, including specialized insurers, namely the Export Credit Guarantee Corporation and Agricultural Insurance Company, AIC. Four of the general insurance companies, Viz, Star Health, and Alliance Insurance Company, Apollo Munich Health Insurance Company, Max Bupa Health Insurance Company, and Religare Health Insurance Company function as standalone health insurance companies. Of the 23 insurance companies that have set up operations in the life segment post-opening up of the sector, 21 are in joint ventures with foreign partners. Of the 21 private insurers who have commenced operations in the non-life segment, 18 are in collaboration with foreign partners. After the state monopoly in the insurance sector was dismantled and private players' entry allowed, the IRDA has played a crucial role in the development and expansion of the sector. There is no doubt in it. But still the sector faces many challenges which, if only tackled well, may one say that insurance is serving the interests of the insuring companies and the covered alike. As per the concerned experts, the major challenges Indian insurance is facing today may be seen as given below. 1. As per various estimates, only 20% of the insurable Indian population is life insured. The share of India in global life insurance is just 0.66%, and life insurance penetration is at present 2.53%, 2004, in the country. The message of life insurance needs to be publicized among the population, especially in the rural areas. Moreover, social security schemes should be expanded to cover the poor masses who lack the premium paying capacity. 2. Experts suggest that health insurance could emerge among the most important factors of improving human development in the country if expanded in a focused way and via an action plan. It is estimated that around 15% of the Indian population is covered under some form of prepayment on healthcare, which includes employees and beneficiaries covered under SS, CGHS, armed forces, central police organizations, railways, employer self-funded schemes, the PSUs and pensions covered under health insurance. As the out-of-pocket expenditure in India is as high as 70%, it is believed that the health insurance sector in the country needs strong presence. As per the NSSO, 2015, the coverage of the government-funded health insurance schemes are 13.1% in rural areas and 12% in urban areas. Economic Survey 2015-16. 3. After the general insurance industry was opened up, 2000, for the private sector participation, the experience has been positive. Its growth compares favorably with that of many other emerging markets and is in line with global benchmark of 2 to 3 times the growth in GDP. As the economy is on a strong growth path and the capital expenditure plan across industries is estimated to be over 9 lakhs crore rupees over the next 4 to 5 years, a better scope for the general insurance expansion is probable. The growth in both commercial and personal lines of general insurance business reflects positive trends. Over 70% of India's population lives in rural areas, and along with organized financial services, general insurance companies are also expanding into these sectors. 4. People in their lives experience financial difficulties that can affect the entire family negatively. This is more true about the poor masses in India. This is why experts suggested for the provision of micro-insurance. A relatively new concept, micro-insurance is today provided to the beneficiaries of microfinance covering the finance amount, reducing the risk of the clients as well as the microfinance institutions, MFIs. The concept of micro-insurance has been developed by the private insurance company Aviva Life Insurance, in partnership with MFIs, which has forged alliances with banks like Canara Bank, PNSB, RRBs, 23 cooperatives, etc., to promote microfinance. Microinsurance has evolved in the past to decades of research in microfinance and has seen growth in countries like Sri Lanka, Philippines in the last decade. Here NGOs and people's organizations are allowed to register themselves as micro-insurance companies which sell such insurance. As they cover the risk themselves, they are allowed to reinsure with one of the large global companies like Swiss Re or Munich Re. Same model is suggested for India, but for this to happen drastic changes in the existing insurance rules are required. 5. Many of the experts believe that insurance industry should benefit the insurers, reinsurers as well as the insured. The social purpose of the insurance sector is never praiseworthy to be marginalized by the corporate interests, be domestic or foreign. At least it does never taste good in India, which needs a strong social safety net. 6. Almost all of the private insurance companies in India have been demanding that the government-owned insurance companies, i.e., LIC, and the 4 general insurance companies, should be converted into private sector companies. Their reasons are logical, as in comparison with the government-owned insurance companies, private companies are always ready with highly attractive and lucrative insurance schemes, but they have not been able to attract the clients for them. Therefore, the private insurance companies have been fetching huge operational losses due to lack of the desired level of their expansion and the overhead expenditure. Insurance penetration and density. The growth in the insurance sector is internationally measured based on the standard of insurance penetration. Insurance penetration is defined as the ratio of premium underwritten in a given year to the gross domestic product, GDP. Likewise, insurance density is another well-recognized benchmark and is defined as the ratio of premium underwritten in a given year to total population, measured in US dollars for convenience of comparison. The Indian insurance business has in the past remained underdeveloped, with low levels of insurance penetration. At present, the calendar year 2018, the insurance penetration and density of India are as given below. Insurance penetration is at 3.71%, 2.74% for the life segment, and 0.97% for the non-life segment, at the global average of 3.31%. The comparative figures for Malaysia, Thailand and China during the same period were 4.84, 5.56 and 4.32 respectively. In case of India, it was 2.71 in 2001 and the highest ever at 5.20 in 2009. The penetration for life segment has fallen down from 3.40% of 2011, while penetration for the non-life segment has been increasing since 2011, when it was 0.70%. Insurance density is at $74, US 19 for non-life, against the global average of US 518, US 406 respectively. It was $11 in 2001 for India. Reasons for underdevelopment of insurance. As per the various volumes of the annual reports published by the IRDA and other government documents, there have been several reasons responsible for the underdevelopment of the insurance penetration and density in the country. 1. Complex and delayed claim settlement procedures. 2. Vague and incomprehensible rules and regulations of the insurance companies. 3. Lack of education and awareness among the masses. 4. Lower income levels of the population. 5. Sociocultural factors. 6. Lack of level playing field in the industry. And 7. Less vibrancy in the regulatory framework. Recently enacted Insurance Laws Amendment Act 2015 is supposed to have positive impact on regulatory framework as well as insurance penetration. Policy initiatives committed to expand and strengthen the insurance industry in the country, following the recommendations of the Malhotra Committee Report, 1993. The Government of India has taken the following policy initiatives in recent years. 1. Health insurance. The Insurance Regulatory Development Authority, IRDA, has been taking a number of proactive steps as part of the initiatives for the spread of health insurance. It had set up a National Health Insurance Working Group in 2003, which provided a platform for the various stakeholders in the health insurance industry to work together and suggest solutions on various relevant issues in the sector. The IRDA is also coordinating with and supporting insurance industry initiatives in standardizing certain key terminology used in health insurance documents for better comprehension and in the interest of policyholders. The General Insurance Council, comprising all non-life insurers, evolved a consensus on a uniform definition of pre-existing diseases and its exclusion wording, which has earlier been an expression with many definitions, still more interpretations, and certainly a whole lot of grievances. Such standardization, effective 1st June 2008, will help the insured by minimizing ambiguity and also by better comparability of health insurance products. Also, with effect from 1st October 2011, portability in health insurance has been started, in which an insured, if not happy with services or the product of the existing insurer, can change to another insurer whilst enjoying the benefits, especially that of pre-existing diseases, of her or his existing policy. 2. Micro-insurance. Micro-insurance regulations issued by the IRDA have provided a fillip to propagating micro-insurance as a conceptual issue. With the positive and facilitative approach adopted under the micro-insurance regulations, it is expected that all insurance companies would come out with a progressive business approach and carry forward the spirit of regulations, thereby extending insurance penetration to all segments of the society. Presently, there are 10,482 micro-insurance agents operating in the micro-insurance sector. New reform initiatives. With a view to removing archaic and redundant provisions in the insurance laws, empowering the Insurance Regulatory and Development Authority, IRDA, to enable more effective regulation, and enhancing the foreign equity investment cap in an Indian insurance company with the safeguard of Indian ownership and control, the government has implemented the Insurance Laws Amendment Act 2015. The Act paved the way for major reform-related amendments in the Insurance Act 1938, the General Insurance Business Nationalization Act 1972, and the Insurance Regulatory and Development Authority IRDA Act 1999. It provides greater powers to the IRDA by which the insurance regulatory framework is supposed to become more flexible, effective, and efficient. Major changes as per the Act are given below. 1. Promotion of foreign investment in an Indian insurance company increased from 49% from 26%, with the safeguard of Indian ownership and control. Greater availability of capital for the capital-intensive insurance sector would lead to greater distribution reach to under or unserved areas, more innovative product formulations to meet diverse insurance needs of citizens, efficient service delivery through improved distribution technology, and enhanced customer service standards. 2. Capital requirement in government companies, the public sector general insurance companies. 4. Presently required as per the General Insurance Business Nationalization Act 1972 to be 100% government-owned, are now allowed to raise capital. This will enable them to have additional capital for the purposes of business expansion in the rural or social sectors and enhanced competitiveness. The Government of India ownership to be maintained minimum at 51%. 3. Consumer welfare. It will enable the interests of consumers to be better served through provisions like those enabling penalties on intermediaries or insurance companies for misconduct, and disallowing multi-level marketing of insurance products in order to curtail the practice of niche selling. The amended law has several provisions for levying higher penalties ranging from up to 1 crore rupees to 25 crore rupees for various violations including niche selling and misrepresentation by agents or insurance companies. B. With a view to serve the interest of the policy holders better, the period during which a policy can be repudiated on any ground, including misstatement of facts, etc., will be confined to 3 years from the commencement of the policy, and no policy would be called in question on any ground after 3 years. C. The amendments provide for an easier process for payment to the nominee of the policyholder, as the insurer would be discharged of its legal liabilities once the payment is made to the nominee. D. It is now obligatory in the law for insurance companies to underwrite third-party motor vehicle insurance as per IRDAI regulations. Rural and social sector obligations for insurers are retained in the amended laws. 4. Empowerment of IRDAI. The Act will entrust responsibility of appointing insurance agents to insurers and provides for IRDAI to regulate their eligibility, qualifications, and other aspects. A. It enables agents to work more broadly across companies in various business categories, with the safeguard that conflict of interest would not be allowed by IRDAI through suitable regulations. B. IRDAI is empowered to regulate key aspects of insurance company operations in areas like solvency, investments, expenses and commissions, and to formulate regulations for payment of commission and control of management expenses. C. It empowers the authority to regulate the functions, code of conduct, etc., of surveyors and loss assessors. It also expands the scope of insurance intermediaries to include insurance brokers, reinsurance brokers, insurance consultants, corporate agents, third-party administrators, surveyors and loss assessors, and such other entities as may be notified by the authority from time to time. D. Further, properties in India can now be insured with a foreign insurer with prior permission of IRDAI, which was earlier to be done with the approval of the central government. 5. Health insurance. The Act defines health insurance business inclusive of travel and personal accident cover and discourages non-serious players by retaining capital requirements for health insurers at the level of 100 crore rupees, thereby paving the way for promotion of health insurance as a separate vertical. 6. Promoting reinsurance business in India. It enables foreign reinsurers to set up branches in India and defines reinsurance to mean the insurance of part of one insurer's risk by another insurer who accepts the risk for a mutually acceptable premium, and thereby excludes the possibility of 100% ceding of risk to a reinsurer, which could lead to companies acting as front companies for other insurers. 7. Strengthening of industry councils. The Life Insurance Council and General Insurance Council have now been made self-regulating bodies. By empowering them to frame bylaws for elections, meetings and levy and collect fees, etc., from its members. Inclusion of representatives of self-help groups and insurance cooperative societies in insurance councils has also been enabled to broad base the representation on these councils. 8. Robust appellate process. Appeals against the orders of IRDAI are to be preferred to SAT, as the amended law provides for any insurer or insurance intermediary aggrieved by any order made by IRDAI to prefer an appeal to the Securities Appellate Tribunal, SAT. 9. Capital market reforms. In March 2019, the IRDA announced the redesigned Initial Public Offering (IPO) guidelines for insurance companies which are looking to divest equity through the IPO route. Now insurance companies are allowed to invest up to 10% in additional Tier 1 bonds issued by banks, which are raising capital to comply to Basel III norms. Thus, the amendments incorporate enhancements in the insurance laws in keeping with the evolving insurance sector scenario and regulatory practices across the globe. The amendments will enable the regulator to create an operational framework for greater innovation, competition, and transparency to meet the insurance needs of citizens in a more complete and subscriber-friendly manner. The amendments are expected to enable the sector to achieve its full growth potential and contribute towards the overall growth of the economy and job creation. Third-party insurance. The third-party insurance is provided by non-life insurance companies on vehicles. This insurance covers the risk on other than the two parties, i.e. the car and the owner, in case of a car involved in an insurance policy. The policy does not provide any benefit to the insured. However, it covers the insured's legal liability for death or disability of third-party loss or damage to the third-party property. This insurance is also known as Act-only cover. In India, it is mandatory, under the Motor Vehicle Amendment Act, 2019, for all new two-wheelers to have a 5-year third-party insurance and cars and commercial vehicles to have a 3-year third-party insurance. The cost of a comprehensive cover is several times that of a standalone third-party cover, since damage claims are more frequent than third-party claims. Until now, the premium for motor third-party insurance was calculated on the basis of a schedule of rates provided by the Tariff Advisory Committee, an arm of the IRDAI, the insurance regulator. But IRDA has done away with the motor tariff. The compensation to the victim is largely decided by the earning capacity of the accident victim. To make insurance policies of vehicles cheaper, insurance companies have been charging a very low premium for such policies. Due to this, insurance companies have not been settling third-party insurance claims quicker, majority of cases going for litigation. But in recent years, the IRDAI has taken various steps to strengthen this segment of the non-life insurance. By early 2020 to 2021, the IRDAI announced a market-linked increase in the insurance premium for the third-party insurance together with enforcing a stricter regulatory regime for quicker settlement of the third-party claims. New insurance schemes. Till April 2020, the Government of India had launched few new insurance schemes aimed at creating a universal social security system for all Indians, especially the poor and the underprivileged. Salient features of these schemes have been briefly discussed below. PMSBY, Pradhan Mantri Suraksha Bima Yojana. It offers a renewable 1-year accidental death cum disability cover to all subscribing bank account holders in the age group of 18 to 70 years for a premium of 12 rupees per annum per subscriber. The risk coverage available will be rupees 2 lakh for accidental death and permanent total disability and rupees 1 lakh for permanent partial disability for a 1-year period stretching from 1st June to 31st May. PMJJBY, Pradhan Mantri Jeevan Jyoti Bima Yojana. The scheme offers a renewable one-year term life cover of rupees 2 lakh to all subscribing bank account holders in the age group of 18 to 50 years. NHPS, National Health Protection Scheme. In September 2018, government launched the NHPS under Ayushman Bharat to provide coverage of up to 5 lakh rupees to more than 50 crore vulnerable families, 10 crore families. The scheme is expected to increase penetration of health insurance in India from 1934% to 50%. Road ahead. The future looks promising for the life insurance industry, with several changes in regulatory framework which will lead to further change in the way the industry conducts its business and engages with its customers. At present, latest for 2018, India's share in global insurance market is 2%. However, the total insurance premium in India increased by 10.4%, whereas global insurance premium increased by 1.4% only. India's insurance industry is expected to reach $280 billion by 2020. Life insurance and non-life insurance industries in the country are expected to grow annually by 13% and 10% respectively for the next 5 years. Demographic factors such as growing middle class, young insurable population, and growing awareness of the need for protection and retirement planning will support the growth of Indian insurance industry.